Welcome to the CFA Society St. Louis podcast. I'm your host and Director of Communication Technology, Al Cubbard. I'm joined today by our Vice President, Brady Ritchie, and by President of the Kaya Association and fellow CFA charter holder, Chris Arends.
Thank you. This is fun. I have a lot to talk about with Kaya, a lot to talk about with business and in general. Take it however you want. I think it's just so fun that you're doing this. I know you have a couple in the backlog and haven't posted yet. So I do have some feedback of things that I think people would like to hear. I wanted to start with a little bit of nostalgia. If your target audience is CFAs, they like talking about how their process was of the test, and that may also help some candidates.
Yeah, today is CFA test week, actually. I have teammates in my office who are taking the test this weekend, which is a big difference. It used to be all in one convention center, one time. There was a certain theater to it.
I liked the theater of it.
Yeah. I did too.
It's so weird to think that your analyst is taking a test tomorrow and mine 2 days later, versus we were all in the same changes. The curriculum's changed since we've all done it.
So he had me thinking, I remember when I took my CFA level 2, it was the weekend that the Blues, St. Louis Blues, had won the Stanley Cup. So we get an email the night before that say, hey, a few million people are going to be downtown. But by the way, if you're late, we will still fail you. And so I did not sleep at all and took my CFA level 2 exam in what can only be described as a fugue state, where you're out of sleep, you're answering the questions, and you will just hear this noise, and you're like, what is that? Oh, that is the marching band outside.
Did you pass? I didn't know you at the time. I was in the room. It was so distracting. Imagine trying to read ethics and you're reading these massive paragraphs and it's just a hum outside. For me, my favorite thing, and also bringing it back to candidates, would be just the preparation and actually trying to apply what you've learned versus just learning it. Jerry Watson, who I'm sure everyone's probably seen at your events before, was also who I studied with, having someone you can actually that can challenge you. I was challenging him a lot. My favorite for level 1 prep, I asked him what Macaulay duration was, and he listed off the equation. Do you remember? This equation. That was this. He knew the equation, but then when I asked him what is it, he couldn't answer it. He only knew the equation, so he had no ability to apply from that. And we had tons of those stories. So when I'm talking to candidates, I'm really impressive at your events. You usually have someone in college or out of school trying to network. I think that I would have never done that. I think that's so impressive. I'll take all of those meetings. And the initial screen out, though, for an interview is when they say, I'm just trying to pass a test. For me, it's you have to try to learn this stuff. And I also like talking about what we apply. So our biggest application from the curriculum, by far, is the 3 buckets. So your personal risk, your market risk, aspirational risk, which also kind of gets you into what you said, Kaya, where the alternatives fit in that aspirational risk bucket. Totally different way to view your whole portfolio in terms of risk and return.
I've been reminiscing because we work on active portfolio management design, which was the big addition in the CFA level 2 curriculum. Transitioning from level 1 to level 2 is when you're being introduced to these functions of how do we evaluate active managers, information coefficient, information ratio, transfer coefficients. And I remember, I'm a pacer at my office, can be kind of a menace, but it helps me think. And so I was working at Wells Fargo at the time, and the product guys let me write each portfolio management equation on one of their whiteboards, so that when I was walking down, I could glance over and
So are you still using that today?
Yeah, I am. We are thick in white papers right now on how do we take these laws of active management and apply them to new portfolio design.
So I still remember the triangle from the curriculum. Do you have any remembrance of any of this?
I do.
Are you using it?
I do. No.
No.
But I mean, that's fine. There's like certain aspects of that. But after CFA for me, I took value investing in technology at Columbia Business School, and for what I do, there is a lot more in the curriculum there, that is applicable to running a concentrated equity portfolio.
That's interesting.
Do you do forecasting out of cash flows? That's something in the CFA that I thought the curriculum stopped a little too soon on. I think it could, for us, what we use here at Gatewood and what we teach, we use Oswath Damodaran's public courses at NYU. He posts them all on YouTube.
Right.
Posts his spreadsheets. We've modified those spreadsheets for our DCFs, and that's the training course I use when we bring on new analysts. They're incredible. My only fear of building out that program is if he ever pulls them from YouTube or he decides he's not doing it, but as long as he's keeping up the history of those courses, I think they're incredible.
Right. So like your story of talking about Macaulay duration, it's like, so you have to apply it. You have to not just memorize the equation, but you have to know how do I use this? And so I teach a couple of courses at WashU and SLU. And and just going through CAPM, it's like, so much of the CFA curriculum is built off of some aspect of CAPM. What are the assumptions to CAPM? So go through each one of those, and then, I ask the students, so does this apply? Does this apply? Does this apply? Do all investors have, the same, homogeneous
Normal
expectations? Can you borrow at 0%? Can you, buy and short anything that you want? So a lot of those different assumptions don't work in the real world. So all of those have to be true for this to work. And so since none of them are true, it's not going to work. And so, you have to just pull out, how does this equation work, and then figure out, well, how do I apply it? How do I figure out what my cost of capital really should be? And so the other way of looking at it is a barbell approach of thinking, well, what is risk? I have a treasury, short-term treasury on one end, and I have venture capital on the other end. And so where am I on that pendulum between those two? And what is my required return? And that's going to be different for every investor.
You're using the CFA nonstop, you just don't know it. So for me, I went from the CFA, and like I said, it's just about, for me it was learning and applying. It gives you great knowledge. My mentor was purely technical. Like, he was trading stocks that you'd laugh at if you saw. And as a CFA charter holder, the first thing you think is, wow, if I can just apply this to something that has good valuation, you think you'll have an amazing result. And results were good once I came in and tried working at that, but the best results from pure quantitative technical strategies was actually trading some more of the lack of a better word, junky names that are unappreciated in the markets. So I knew I wanted to do quant. We run a quant strategy here in our IRAs that have high turnover, relative strength. And so I did the CMT, so it's market technicians. Some good things, like the trading that we do, which is rules-based, models, a lot of that, but then it's going to throw in things that you would laugh at, like Elliott Wave, or things that you're never going to use. And that's for CFA charter holders, it's 2 tests, it's 3 overall. So I felt like I had a good background, and then I got quant, which CMTs take a bad rep. I was actually just with chief market technician of LPL over the weekend. He said, stop calling it technician. You're just a quant. Just like the hedge funds, it gets a bad name. You're a quant trader. And then I wanted to do alternatives as well. And since the CFA, since we've all done it, they've added a lot of alternatives, which is good. Kind of coming after the Kaya Association a little bit. But then I went and did the alternatives as well with Kaya.
Yeah, they have the new alternative investment module, and level 3 it seems like you can pick electives these days, and I haven't seen enough of the curriculum to know where that overlaps with Kaya, having taken both the CFA and Kaya exams myself.
I haven't seen it either. I follow it through Mark Meldrum, who I studied with, and he'll post about it a little bit. Like I said, I love the CFA that much. I still follow what I can get from that, and he'll do videos on the pass fail and how percentages. I'll still watch those, but he was breaking it out between I think it's portfolio management, financial planning, and then alternatives, and just the decision on level 3 of which one you do. I have no idea what's the good alternative. I know a lot of our guys, some of them have chosen financial planning just because we are a financial planning firm first. And like I said, it's about learning the info, not what's easiest, but that is, if you're coming from financial planning and then you go take that test, that's by far going to be the easiest.
I distinctly remember when I took the exams that the alternative piece of the CFA exams seems more quantitative in what it was trying to do. Like, how do you evaluate how these things perform? Whereas what I appreciated about the Kaya very specifically was the due diligence angle of it, because when you're working with these alternative investments, the portfolio manager matters so much. And
that's the big difference, right? The thing that'll hit your face on every single alts book is people and process. You go to the public markets, which 99% of what I do is public markets, even though I do a lot with the Kaya, talk a lot about alternatives. It's under 1% of our AUM. You'll see it all the time. We don't specifically use them, but for an example, you see people with a portfolio that's 100% Vanguard. Do you have any problems with that?
100% Vanguard?
Yeah, 100% with one manager.
No.
No issues, right?
No.
But if you go to an alternatives platform, it's 100%. We're not allowed to say all. Use the compliance issues. You can't say 100% in one alternatives manager. That's generally a problem. Could be.
Yeah.
You have issues that can come up, all sorts of issues. As an alt investor, it's inevitable you're going to run into something. A private equity that has problems. We don't invest in private debt, but how could you not have some sort of issue there at some point? So people, process, finding people that are different, processes that are completely different. For us, we apply similar fundamentals that we do for public markets, and we just take it to size. We're going to have we use 3 funds in our private equity. A lower middle market, so we're doing small. Those are control. They're taking control of those businesses, trying to improve them. I use a core, someone who's just trying to really be the market. They would tell you they're trying to beat the market, but blend in there. And then we go, you kind of referenced it earlier, venture or large cap, late growth. So for our strategy, we're hitting the same way, kind of the CFA we talk about in public markets across size, and of course 3 different managers across there as well.
have you noticed, I know when the CFA Society and Kaya will have speakers on private equity come in, and they'll talk about how private markets are getting bigger and how the companies within private markets are getting bigger. And I just think, we live in such an information-driven age now, and so finding information about private companies is easier than it used to be relative to public companies, which is, for a while been fairly easy to get information. Do you think that is the private markets and the public markets become more similar? Have you noticed that in your
practice? Have a
practice?
question for you from the academic side of this, actually. Because what that leads to me is, in the public side, you have small cap premiums, going back in the 70s, early 2000s. Is that moving to private markets? Do you think when we're forecasting out the things that nobody does, like you said, you're forecasting out your small cap returns, maybe that has a premium above large cap, has some of that premium shifted into where places, because I think what you're saying is small cap is becoming more efficient, and the inefficiencies are private, where private information is actually still legal because it's private, there's no transactions. What do you think about public small cap?
I think that public small cap used to be the place that you would go for higher risk with the promise or the opportunity for higher return. But now, if you look at some of the private companies that we were talking about earlier, like the AI companies, for example, those aren't small companies. The companies now are just so big. The AI companies that we were talking about before, 100 billion market cap, far from, the small cap, market cap of, $2 to $8 billion. So, the idea of risk is still there, but the small caps are the universe has really shrunk.
And you kind of referencing it that they're staying private longer, and there's more money going into that space. Well, if I'm allocating to a venture manager, I want him to hold the business longer. I don't necessarily want him to IPO it in a year. So I think people always talk about this. I think it's just going to keep going. It's going to elongate. But these guys are a little bit different than we are on the public side. One of the managers we used just led the Anthropic round at the beginning of the year. Well, he's already got a 3x in it. He's probably not going to hold that thing for 10 more years. If the public markets want to take it off his hand for a 5x,
Yeah.
he's probably out.
Well, I think a lot of the small cap companies, were companies that had a smaller total addressable market. They made more of like a niche product, or they were a company that specialized in a specific geography. And with a lot of the large private companies, that we're talking about now, they have a much larger total addressable market.
The other interesting thing with events, so how we're different from you guys is you guys monthly, or maybe even more than monthly on events. We're trying to do 4 a year. So to fill a room at 4 a year, you referenced it, we've done private equity a lot. If 85 people want to show up to talk about private equity and private credit, an interesting topic would be real estate, where right now you may get 20 people, 25 people interested to talk real estate. If you did a hedge fund event, unless you found an incredible manager with huge name value, but you get 20 people interested in hedge funds. So it's kind of everything we're saying, which is there's so much
hedge funds generally, because like two hedge funds, like even two relative value hedge funds, like can be drastically different in what they're trying to accomplish.
Yeah.
So meet Chris. Meet Chris beyond Chris's resume and beyond, what Chris's background is, but, hear his story. Everybody has a story. So this is our chance, to let that person tell their story.
Ironically, my professor in college is now in the he also owns an RIA.
Yeah.
He taught me equities in sophomore year. And that's what I always had the idea. I'm like, why is a guy like this teaching? It seems like he knows. He should be out applying in the real world. And 5 years later, he is, which was kind of funny to see. And in those courses, I knew I was doing chemistry, and I was pre-med and finance major. So I had both options that I could go to med school. It became pretty obvious I wasn't going to go to med school, and just approach this route. And that's why I kind of referenced it earlier. I want to help the young members or candidates, because I had an amazing mentor. He was 80 when I started, and just sat under him for multiple years. Like I said, he's a quant guy, learning the quant, trying to bring in the fundamentals with him to create a strategy that we run today. And I've been at Gatewood for 8 or 9 years, and been a partner for about 1. And we run at 1.7 billion in assets. Like I said, 99% of it is traditional investments, quant in our IRAs, where we have no tax issues, and then long-term stocks in our trust accounts.
So what kind of decision was it for you to decide to buy an existing firm?
I started at Northwestern Mutual, actually, on the investment side, and was working with the John Gatewood, who obviously the name of our company, and my 4 partners actually bought him out. And so then after I had been here 8 years, I had met the requirements of what we had for partner, and I bought in last year. And so pretty long-term focused here.
So we talked about Demoter, and he does a whole thing about numbers and stories. Are you a numbers person?
I started as a numbers person. That's a great question. I started as a numbers person, and what Demoter always says is because you can make the numbers fit anything, small changes in long-term forecasts. So and it's really the story of him. He was originally in his career numbers guy, and then switched that he's now stories. So no, I'm not very good in Excel anymore. I've gotten very good inside of Claude for asking questions. I think we all have, just being forced to do that. And now it's become more stories. So what we found out through all of the testing we do a lot because of the quant background, where we wanted to be from a risk standpoint, stories can't make up more than a third of the portfolio. If you have 50, 60, 70% of your portfolio are these big stories, your strategy can go out of favor for a really long time. So we want to be similar to the market. So we created a strategy that's really a blend. We do have a trading part of the portfolio, even our taxable accounts. We have a blend that's just active beta. So it's like the active indexing that a lot of people are using. That's a small piece of the stock strategy. It's about a third, and then the final third is discounted cash flow, stories that can go out of favor, but we know we're sticking with them, and the market can get things wrong in the short term. We blend that together for a strategy where our goal is plus or minus 3% of the S&P 500 is what we're trying to accomplish, and measuring our risk so that we don't go outside of that. If you can beat the S&P by 10%, you can underperform by 10% pretty easily, and our clientele, that's not what they want. So it goes back to the buckets. We have our liquidity set up in our first bucket, our middle bucket similar to the market, we just want to be around the market, hopefully to the upside, and finally those that want to outperform the market or look for the chance to do that, we're in alternatives, specifically private equity. I always tell the quick story, got lucky with private credit, and we were kind of long-term AI guys for a while, which we thought that would bring rates down. Obviously we have a short-term headwind here from the war, bringing rates back up. That changed that thesis, but the idea of rates coming down kept us with the forecast that base rates would be low, and that kept us out of private credit with the floating rate debt. So it's a good problem to have.
Mm-hmm. So what about, Chris, the person outside of work?
I don't do anything, man.
Family, interest?
2 daughters.
Chris, what's your favorite podcast?
Yeah, we already cut it out. You asked me favorite movie and TV show, and I don't have that. So I do listen to a lot of financial podcasts. I like The Compound for entertainment. I think they're fun. I like anything Oswath posts for information. Same with Mark Meldrum. He posts every weekend. He's gotten a little too political. I try to just listen just for the content and stay away from the politics. Hopefully your podcast is going to take off. We'll add that to the list. And then every day I listen to the most bearish podcast out there to get the other view. But a long-term bull, very bullish, and Risk Reversal. They're 2 guys who are on TV every day, Nathan and Adami. They do a good podcast, but I want to know what else is out there, as what are their talking points that are very bearish, just to challenge myself on that. And it's entertainment. They do a fun job.
Yeah.
Make fun of themselves when they get calls wrong, and so those are my favorite content.
What are how much do you read outside of investing?
A lot less than I used to. It's almost all investing. I'm not reading anything now. I get pulled back into management books. I mean, that's my biggest gap too. As you know, running an RIA, if you have people working with you, that's my gap as a manager. I manage a team. When the markets get volatile and that's all I'm focused on, focus on that. And things have been going pretty well for us. But my skill as a manager is what's been lacking. So thank you for that call out. I do need to get back to that and read more of those books.
Well, Chris, thank you so much for joining us today.
This was a blast. I was glad you could come here to our studios.
Yeah, and thank you, viewers, for watching. And we want to give a special thank you to Gatewood Studios and their management for letting us borrow the studio. CFA Society St. Louis does not have an office, so usually these are digital, and it was a lot of fun to do it in person. We appreciate it.